Hello, my name is Kenneth Himmler. I'm the CEO and founder of Integrated Asset Management, a wealth management and financial planning firm. One of the items that we're going to talk about today are the things that could impact your taxable income, because we do live in a progressive tax rate system. Let me first explain what a progressive tax rate system is. It means that you are taxed at a higher rate based upon the higher the income that you earn. Other countries, many European countries, have a $0 from $0 or zero, whatever their currency is, tax system. So as an example, in Germany, if you are making $250,000, you might be paying 50% tax on the entire $250,000. In our country, the way it would work is if you made $250,000, this is only an example, but the first $50,000 might be taxed at 10%. The next $50,000 might be taxed at 15%, and so on and so on. Now, the way it works is in our country, you can't take the rate at the top bracket and say that that's the rate that you're paying. You have to compute each of the brackets, total up the tax, divide it into the total income that you have to come up with what's called the effective bracket. Now, many items will affect that effective bracket, such as wages, taxable dividends and interest, and even municipal bond interest. While that doesn't directly affect the tax bracket, it could affect other items as to how you get taxed. Your rental income, certainly any type of Schedule C self-employment income. Also, up to 85% of your Social Security benefits could be taxed. In addition, any IRA withdrawals or pensions could be taxable. Now, some of the items that you have to be very careful of are capital gains. That's a big one because sometimes those surprise you. And if you own mutual funds, sometimes mutual funds will pay out what is called a phantom gain. That is where the manager of the mutual fund sells certain items that create a gain. Even though the mutual fund might still be at a loss, you might be paying taxes on capital gains. In addition, IRA required minimum distributions. You have to be very careful because when you hit age 70.5 and you start taking money out of IRAs, you might have an unpleasant jump in your tax bracket. Welcome to the progressive tax system. The other items that may surprise you or may affect you might be when you reach a certain income threshold, you start paying taxes on your Social Security. When that up to 85% of that taxable Social Security comes in, that will then possibly affect the bracket that you're paying on all of the additional income. So the rule of thumb is this. Be very, very careful if you have mutual funds, number one. Number two is be very careful if you have an IRA, because these are items that are mandatory withdrawals. Number three is be very careful if you are selling items that have capital gains, that this may not, that you analyze to see if it puts you into another tax bracket. So, progressive tax system in the U.S. is affected by any types of income that are taxable to you. Thank you very much. And again, I'm Kenneth Himmler from Integrated Asset Management.